The year is 2013, and investing wizard Bill Ackman has taken a short stake in an MLM called Herbalife. This dietary supplement company has a somewhat predatory business model that makes new customers buy Herbalife products and recruit others to do the same. Almost everyone who joins loses money, but in terms of business models, it was pretty solid. Ackman knew this and instead pursued a battle against Herbalife on more moral grounds. He claimed the company targeted immigrants by selling them the American dream, a dream that would never come true for the vast majority. He even teared up during his presentation recounting his immigrant father's struggles. This is why all the profits from this venture would be donated to charity. It wasn't about the money, but about taking down a criminal enterprise. So, Bill borrowed about 20 million shares, about $1 billion worth, and sold them short. In December 2012, Ackman unveiled his position with a 342-slide deck explaining why he believed Herbalife was worthless. Initially, it seemed like he was onto something, with the stock falling over 50% by the end of the month. But then came the star of the show, Carl Icahn. Just over a month after Ackman took his stake against Herbalife, Icahn came out with an announcement of his own. He was taking a bet in the company's favor. As a direct challenge to Ackman, Icahn bought over 14 million shares of Herbalife with the help from other famous investor Dan Loeb. Bill Ackman began feeling the pressure as Herbalife stock soared. The feud between Ackman and Icahn ultimately culminated in the two investors getting into a heated argument live on CNBC.
I really sort of had it with this guy, Ackman. He's like the crybaby in the schoolyard. He was like one of these little Jewish boys crying that the world was taking advantage of him. It's like in the old song, you rue the day I ever met the guy. Ackman is a liar, okay? That, without question, I will swear to it on any Bible you want. I got to tell you, I left. I couldn't figure out if he was the most sanctimonious guy I ever met in my life or the most arrogant.
Carl, you and I can talk offline. We're wasting the world's time on this. I think that Carl either has a very, very bad memory or he has trouble with the truth. Carl, after the whole thing, called me up and he literally said, Bill, we can be friends now.
I never said that I want to be friends with you, Bill.
Okay, let's move on.
I would invest with you.
Let's
you were
move
the last man on earth. I appreciate, Bill, that you called me a great investor. I thank you for that. Unfortunately, I can't say the same for you. But I'd like to ask you, congratulations on one good trade. I sort of missed that.
And from this point on, Herbalife stock doubled and Ackman started hemorrhaging money on this bet. But he persisted with waging war, both financially and in the courts, to get the company shut down. Ultimately, Icahn proved to be the victor, with Ackman closing his stake and losing over $750 million. This war between these two investors solidified the legend of Carl Icahn in the minds of a whole new generation. But this show of strength would not be Icahn's last, nor was it his first. Going all the way back to the very beginning, we now look at Icahn's pre-investor life. Raised as an only child in 1940s New York, the future billionaire lived a fairly understated childhood. Eventually, he attended Princeton University, where he learned about the legendary Frank Cowperwood from two books, The Titan and The Financier. Despite his fictitious existence, Cowperwood was a ruthless businessman in the pages of these two books. From flipping soap at a 70% profit, going bankrupt by misusing funds from the treasury, to making millions again investing in stocks, you could say Icahn's investing life mirrored that of Cowperwood's. Armed with ambition and education and an extra $400,000 from his close uncle, Icahn purchased a seat on the New York Stock Exchange to set up his company, Icahn & Co. Founded in 1968, the fledgling company dealt primarily in arbitrage and options, two concepts introduced to Icahn via Cowperwood. Armed with these tools, Carl Icahn soon set his sights on the Tappan Stove Company. Up until the 1970s, Tappan was an iconic brand in America. With a reputation stretching as far back as the 1890s, Tappan was known for its high quality but often pricey appliances. From stoves to fridges and the first commercially available microwaves, Tappan was the third largest appliance seller in the United States by the 1950s. The only other companies that eclipsed it were GE and Electrolux. Founded by a persistent W.J. Tappan, the company lived on in the family and was later overseen by Tappan's grandson, Richard. Richard faithfully executed the role of chairman for nearly 20 years. His leadership saw the company soar to all-time highs and eventually near fatal lows. Bolting on a brand new air conditioner business to its already large appliance business, Tappan went through quite the change. During this transition, the company struggled and saw a dramatic drawdown in stock price. It was in the midst of this price crash that Icahn brought up the idea of selling the company to a competitor. To introduce the idea, Icahn set up a lunch with himself and Donald Blasius, the president of Tappan, with a special guest. Fred Sullivan was the president of Walter Kitty & Co., a conglomerate that made kitchen tools complementary to those offered by Tappan. Blasius, unaware Mr. Sullivan had been invited, promptly stormed off, declaring he had no intention of talking, nor was Tappan for sale. This hiccup didn't really stop Icahn, as he continued to buy more and more of the company, and towards the beginning of 1979, Icahn would really make his move. See, Carl owned so much of Tappan that he was forced to file a Schedule D. It was then the general investing public found out about his attack on Tappan. Due to these circumstances, he approached the board of directors demanding a 10th board seat be created for him, as he searched for a buyer for the company. After a lot of pushback, the board relented, and Icahn, for the first time ever, had claimed a board seat of a publicly traded company. This was the first time anything like this had really happened in the finance world. Companies weren't used to random investors showing up, buying large stakes in their businesses, and trying to get them sold or make major changes. And in the early stages, the idea of these corporate raiders, as they came to be called, had quite the poor reputation. Many of these raiders stripped companies of their assets, forced bad sales, or blew up the company by using too much leverage. As such, the practice died down for a while and was eventually rebranded as the more relaxed-sounding activist investors. This new class of investor bought stakes in companies and tried to make smaller changes to improve those companies instead of trying to take over altogether. But this was the 1970s, and Icahn was still in the middle of his war to get Tappan sold. And he did. Eventually, Tappan's stock price recovered a fair bit, and Icahn found a buyer in Electrolux, the Swedish appliance manufacturer. While this chapter in Carl Icahn's life would be important, it didn't net him that big of a return. Sure, he doubled his initial investment, but there were bigger fish to fry. Or, should I say, planes to ground. While the saga of Tappan solidified Carl Icahn's reputation as a ruthless businessman, the next major conflict caused many to just downright hate the guy. After finishing up some smaller conquests, Icahn met with an advisor to talk about a potential takeover of Frontier Airlines. Ultimately, the plan was shot down, but another airliner kept coming up in their conversations. Trans World Airlines had built an empire. Having been started in the early 1920s, it was a major beneficiary of the World War II plane boom. The main driver of this was the use of planes to deliver mail and eventually people from one part of the country to another. As one of the major flyers in the space, TWA had the best service, routes, and technological progress. But one thing that hampered the airline was the Deregulation Act of 1978. This entirely removed the complete government control of all airliners and left TWA on its own to figure things out. Just 7 years later, TWA still hadn't figured it out. It was perpetually unprofitable and several times on the verge of bankruptcy. But Carl Icahn was determined to change that. He figured out all that was needed was better management. Instead of trying to make the best airliner, he thought he could show up, cut costs, and sell assets to get things running smoothly again. After starting to acquire a stake in 1985, Icahn owned the whole company by 1988. As soon as the buyout was complete, he set out to fix the company. By fix, I mean, of course, line his own pockets. He demanded concessions from the union and then bought another airliner he had no business buying. He also sold TWA's most profitable and frequented routes. The whole time Icahn was in control of TWA, he demanded the unions make concessions, first on wages and then later offering them stock, which ultimately went to zero just a few years later. 4 years after Icahn took over, TWA filed for bankruptcy protection and emerged a year later being mostly owned by the creditors, the largest of whom was also Icahn. And despite multiple lawsuits against Icahn, TWA was hard-pressed to get him to leave. Eventually, the airliner got rid of Icahn by offering him a 55% discount on tickets, which he turned around and sold to the public on a new website called lowestfare.com. This meant TWA was basically competing against itself for cheap airline tickets, but it also meant that Carl Icahn was out and the company could focus on revenue and making profits. And the company fought for every penny it got. For a few months in 1995, after Carl Icahn, 2 bankruptcies, and losing its most profitable airline routes, TWA finally made a profit. But a plane crash in late 1995 sealed the company's fate. Consumers lost trust in it, and TWA ultimately sold its remaining assets to American Airlines in 2001. The early years of the Icahn empire were really the golden years. His company made money at every turn. The big stories are Tappan and TWA, but there were a lot more. While Icahn was in the process of buying TWA, he offered an $8 billion buyout of US Steel. This endeavor proved unsuccessful, but Icahn made a large profit. Over several years, he was a major shareholder. He did get the company to play ball with a few of his ideas, such as selling off certain gas and oil assets. Speaking of oil and gas, Icahn started to agitate one of the largest oil and gas firms in the country at the time just a few years later. Texaco, like many other companies Icahn targeted, had just emerged from Chapter 11 bankruptcy protection. During this period, the company rearranged management and tried to realign shareholder incentives. Icahn started buying shares and adding his input, but instead of his usual harmful input, Icahn actually helped the company financially. This short back and forth ended with Icahn agreeing to stop purchasing Texaco's stock, no longer submitting takeover bids, and stepping down from his advisory role at the company. A few years later, he actually made the largest stock sale in New York Stock Exchange history, selling over $2 billion worth of Texaco stock in the open market. But after the TWA fiasco, Icahn resigned himself from any more large takeover attempts. The finance world had started to shift away from these corporate raiders who would come in, plunder a company, and ride off into the sunset. Instead, we had a new breed of much more successful investors. One of the firms that helped restructure TWA in the mid-1990s was Elliott Management. At the time run by Paul Singer, Elliott was primarily focused on distressed debt and restructuring deals. The firm's body of work includes Enron, WorldCom, and of course, TWA. But in the early 2000s, Elliott shifted primarily to buying stakes in companies like German haircare company Wella AG, where it attempted to block a takeover bid from Procter & Gamble. Elliott believed the company could be valued much higher, and eventually, the firm won this dispute with Procter & Gamble, getting them to pay $98 per share instead of the original offer of $65 per share. Carl Icahn seemed to really like this idea and shifted towards this new activist model with his peers. In addition, he also started to emulate Warren Buffett by buying passive stakes in companies he thought were undervalued. Another way Carl Icahn emulated the Oracle of Omaha was the fact his company was publicly traded. Almost from the inception of Icahn Enterprises, you could invest right alongside Carl Icahn. Having IPO'd in 1987, IEP returned about the same as the S&P 500 from 1987 to 2022. 2023 is a different story, but we'll get to that a bit later. As I said, Icahn changed his ways. Kinda. Instead of going full-on takeover mode, he became a more passive investor. A few of these early 2000s investments included Blockbuster and Time Warner. Time Warner in particular was interesting because he wanted the company to spin out its various segments. He instead settled for the board buying back his shares at a premium. This result is something that happens quite frequently with Icahn. He buys a stake in a company and then threatens to start pushing for board seats and making changes unless that company buys back his shares at a premium. In fact, this practice has a name, greenmailing, and is a perfectly legal thing to do in the United States. For some reason, Icahn uses this legal system as a cudgel to get his way very often, from suing Motorola to the point of splitting the company in half, suing Dell multiple times over to takeover bids and IPO plans. He even sued pharma companies like Biogen for access to documents. This all led Icahn to record profits and incredible returns for investors in his enterprise. While the 2000s and 2010s saw Icahn become less takeover-oriented, this is the period where Icahn made the most money, crowning him as a billionaire. It also provided some hilarious moments, such as the incident with Icahn in 2012. But much like the imaginary Frank Cowperwood, cracks started to form in the immortal facade of Carl Icahn. While Icahn had many blunders in his career, such as holding Blockbuster till near bankruptcy and his bad bet on Hertz in 2016, nothing could compare to what was to come. The big trouble really started in 2015, with Carl Icahn making a big bet on energy. While Warren Buffett and Berkshire were selling their stakes in oil companies, Icahn decided to persist, believing oil could go higher still. Unfortunately for Icahn & Co., the price of oil collapsed just months later, resulting in a loss of over $9 billion. A few years later, in 2017, he would lose $2 billion trying to protect his portfolio from losses. This technique, called hedging, is a topic that will come up again in a minute. And Icahn would lose another $2 billion in 2020 betting on Hertz, the rental car company. He did manage to turn things around a little in 2021 though by shorting GameStop and making some money, but the roll came to a stop in 2022 when Icahn took on the board of directors at McDonald's. Oddly, he took the position of being pro-fair treatment of animals by McDonald's cattle farmers. This is most likely related to his daughter's vegetarianism, but it is true that McDonald's did not live up to its 2012 resolution to stop the poor treatment of animals. Whatever the case may be, his attempt to make changes fell flat. However, these minor losses didn't really hamper Icahn much, but in May of this year, Icahn faced off with an opponent he had never faced before. Hindenburg Research is a firm that investigates problems in public companies, buys financial products called shorts, and releases its report in hopes of making a profit from the fear created by that report. And Hindenburg is one of the best in the industry. Let's use an example to further explain some things. Imagine there's a really expensive watch for sale. It's priced at $25,000 because there's only 50 in existence. Now, let's say you found out the company producing and selling this watch had a secret warehouse with 500 of these special watches. You plan on making this information public, but first you find someone who wants to buy the watch. You sign a deal to have that person buy one from you for $25,000. So you release a report talking about this secret warehouse, then the price of the watch falls to $18,000 immediately. You go out and buy this watch to immediately turn around to sell to your client you signed on earlier for $25,000. You now profit $7,000 because of the panic you created by releasing damaging information. In essence, this is how short selling works. Hindenburg released a report on the Adani Group, alleging what essentially amounts to fraud. Gautam Adani, the third richest person in the world, consequently lost more than half of his wealth in less than a month after the report. So how does this tie back to Icahn? Well, Hindenburg had some very interesting claims to make against the man, such as the claim of a Ponzi-like structure to his business. This claim is really important and worth exploring for a minute. As you might know, generally a Ponzi scheme is where a company attracts investors by promising a nice return. Then, as more money comes in, it is used to pay back the initial investors. Eventually, this structure collapses as the new money coming in dries up. Now we turn to Icahn Enterprise Partners. We can see something that somewhat appears like a Ponzi scheme. Icahn Enterprises has paid a dividend for a very long time. In addition, it has increased the amount paid to shareholders multiple times over the years. The problem is that IEP doesn't produce the cash flow to sustain this dividend. For instance, in 2017, free cash flow was a negative $1.7 billion. In that same year, the company issued $1.7 billion more in dividends. Normally, this would require IEP to take on some debt, but the long-term debt has stayed mostly the same. So how could Icahn pull this off? It's simple. Sell new shares on the open market. One of the ways a public company can come up with money seemingly out of nowhere is by diluting shareholders and issuing more shares. If IEP had 10 shares outstanding, it can file to create 2 more shares at the current or lower market price. It sells these 2 new shares to investors on the public market, and that puts extra money in the company's pocket. And this is how IEP keeps paying its dividend, by using the money from new investors purchasing newly minted shares on the public market. Icahn Enterprises could then use that money to continue paying its dividend to its current shareholders. While it's not a perfect one-to-one, I imagine some will see Hindenburg's claim as remotely legitimate. Either way, diluting shareholders to pay a dividend is almost never a good look for any company. While this is the largest claim, it is just the first against Icahn's vast empire. A common theme throughout Hindenburg's report is that IEP plays a complex shell game, from valuing its stakes in companies much higher than they should be, to not reporting key metrics surrounding his company's debts. Yet perhaps the worst offense is the most innocuous looking one. Icahn controls 85% of IEP and has pledged 60% of the shares of the company to margin loans. These loans are only guaranteed because he put those shares up for collateral. In other words, Icahn would find himself in big trouble if the shares of his company were to suddenly drop, let's say, 40% in a short amount of time.
We do have a bombshell today from short seller Hindenburg Research, which is revealing a new short position against Carl Icahn's IEP. Hindenburg also goes after IEP's dividend yield of 15.8%. In brief, Icahn has been using money taken in from new investors to pay out dividends to old investors. Such Ponzi-like economic structures are sustainable only to the extent that new money is willing to risk being the last one, quote, holding the bag.
Hindenburg's report did do damage, not only to Icahn but also to his empire. The stock price of his company sits down over 40% from where it was just a year ago. Will IEP go under? Probably not. But will it ever reclaim its former glory? Probably not either. Add on top of this Icahn's recent $8 billion mistake betting against the recovery of the American economy, and it seems Icahn's days as the leader of IEP might be numbered. Even as Icahn's business recovers from these blows, he faces the same problem many other big money managers have faced throughout the last century. Icahn just can't bring in the same returns he did when he was a much smaller business. As businesses grow in size, it becomes harder and harder to outperform. The bet sizes get bigger, and so do the fees, so it becomes harder to sell the positions you have. If you or I want to sell a stock, we can just go to whatever brokerage we use and tell it to sell the shares to whoever wants them. But if you're Carl Icahn with a multi-billion-dollar position in some energy company, it becomes a lot more difficult to liquidate that position. This fact is also somewhat evident when you look at Icahn's enterprise performance over the last 10 years compared to the S&P 500. It returned almost half as much money to investors in comparison. On top of that, this unfortunate fact has also dampened Icahn's reputation further. Despite these setbacks, Icahn remains as chair and chief investor at Icahn Enterprises. In a recent interview, Icahn said he has no plans to retire, so long as he's healthy and has all his marbles. Although, in a surprising move, Brett Icahn returned to his father's business to help run things just a few years ago. He previously left to pursue another career outside of finance, but was ultimately drawn back in. So while Carl Icahn is still in control, it remains to be seen for how long this will last. Yet, what we do know is there's a whole new generation of investors who have a very different view of this investing magnate. And as for the older generations, well, they got to witness the rise and fall of a Wall Street icon.